Today in this video, we're going to talk about which mortgage is the best one for you to get. You may have an idea of which is the best mortgage for you, but that may not be the case. Check it out. Hi, I'm Rhonda Burgess. I'm a real estate broker and mortgage underwriter here in the Nashville, Tennessee area, and my firm is Southern Living Realty Partners. Okay, we're going to start off with, I'm going to go over 4 types of mortgages. We're going to do VA, we'll do FHA, USDA, and we're going to do conventional. And we're going to talk about the pros and cons of each. First, I'm going to start off with my veterans. Thank you for your service. All right. So, VA loan is generally a 100% loan. It's 100%. You don't have to put any money down. It is backed, or rather guaranteed, by the Veterans Administration. Okay, so it's for veterans who served, whether you were full-time military service, you were reservists, National Guard, stuff like that. A lot of times you can get your, as long as you've had honorable service in the military, you can use a VA loan. Again, it's 100%. You don't have to put any money down. VA underwriting is very flexible. You can own other properties, and you can still be able to purchase a second home using a VA loan. There's no exclusion about other properties that you own. You can own a house and keep that house as a rental or whatever, or you're purchasing a second home or whatever. So you can do all of that with a VA loan. The VA has a funding fee. Okay. So the first time you're using, let's say you've never used your VA eligibility before. You've never used yours. Okay. So it's going to be 2.1% is the funding fee. 2.1% of your loan amount is going to be the funding fee that has to be paid. If you are using your VA for a second or a third time, or however many times after that, and you're doing 100%, no money down, it's 3.3% funding fee. Now, if you receive disability compensation, or you have a rating from the VA as far as your disability is concerned, the funding fee may be waived. It may be waived. But if you do not have any rating, you don't have any service-connected disability, you're not receiving disability payments, it will be 2.1% the first time, or 3.3% for any subsequent use, and that's for the 100%. Okay? The other good thing about the VA loan, there is no mortgage insurance. There's no upfront mortgage insurance premium, and there's no monthly. There's no MIP, monthly. There's no mortgage insurance premium paid monthly either. So the VA loan is a very good loan to get. Now, I'm going to say probably 2 of the biggest drawbacks I see with VA loans are, a lot of times sellers don't want to deal with the VA loan because they feel that the appraisal will be stricter. On a VA loan, there's a lot of fees and things that the veteran cannot pay, period. And that would require either to be rolled into the loan, like the funding fee. You may have to roll your funding fee into your loan amount, or you would ask the seller to pay for it. That can be expensive. 3.3%. Let's just say if it's a $100,000 house, that's $3,300 already. It's a $300,000 house, you're talking about almost $10,000 in fees. And so for the most part, a lot of people just add it to their loan amount, roll it into the loan. But do you have enough room in your DTI to roll that in if the seller's not willing to pay it? You see what I mean? It is very good loan. I've had a VA loan. I think I'm on my 4th VA loan now. Okay. So I've used my VA loans. They are very good, but just know that there are other fees and there are rules about who can pay for what. So if you're looking at a property where the seller is unwilling to contribute enough money to cover maybe your realtors, your buyer's agent commission, closing costs, and your funding fee, then you may need to look into rolling that funding fee into your loan if you have the room. Some people don't have the room. So you may need to, pay off some other debt or do something else. But just remember that funding fee is always going to be there. No mortgage insurance every month, which is wonderful, which is very wonderful. But you will have that funding fee. The way to get a reduced funding fee is put at least 5% down. If you put 5% down, whether it's your first use, your second use, your third, your fourth, whatever, if you put at least 5% down, the funding fee is only 1.5%. So just keep that in mind. The VA, I suggest if you are a veteran and you qualify and you are eligible, and listen, it doesn't take that long. It used to take weeks for us to get our certificates of eligibility from the VA. It's streamlined now. It's so much faster. So seriously consider a VA loan if you are a veteran or a spouse of a veteran, where you can take advantage of the good parts of that VA loan. All right, I know I said these in a different order starting off, but I'm going to go to USDA next. USDA, another 100% financing mortgage. You do not have to put any money down. You do not have to put any money down. It's 100%. The seller can pay up to 6% of your closing costs. You can use grants that you get from the local community with a USDA loan. I've seen it done all the time. Here we have THDA, Tennessee Housing Development Agency. So they can help with, they can give you money towards down payment and or closing costs. So you can use grants with it to get your closing costs paid. Okay. We do not have at USDA, we do not have mortgage insurance. We do not have mortgage insurance. It's called it's our annual fee. The annual fee is normally equal to 0.5% every month. So it's very low compared to mortgage insurance premiums. Okay. Also, we have what we call it's a 1.5% up front. That's like the funding fee for VA that I just talked about. It's a 1.5% on USDA that helps to fund future USDA loans. Okay. So your costs are minimal. But the caveats to the USDA loan, you have to be buying in a rural area. The rural housing maps are determined by Congress. I'll put a link in the description to the USDA map so that you can see, if the property that you're looking at falls into a rural area. It has to be in a rural area. You cannot use rural housing, the guaranteed rural housing, or the direct if it's still there. You cannot use those in the city, only in a designated rural area. Okay. You will have that 1.5% upfront. You can roll that into the loan amount. So you don't have to pay that upfront either. Your seller can pay your closing costs. Your seller can pay up to 6%. You can use a grant with it, but you've got to buy in a rural area. Number two thing about the USDA rural housing loan that knocks a lot of people out is the household income limits. USDA has an income limit, and it looks at the entire household. So it is not just the people who will be on the loan. It looks for income and benefits from everyone in the household. So if you have a mother, you got a married couple, right? And they got 2-3 kids. And let's say her mama lives with them too. Okay. The wife's mother lives with them too. Then you've got to list everybody in that household, And then we have to include everyone's income in that household. So if you have, your children are living there, they have children. If those children are high school age or older and they have a job, whether part-time, full-time, sometimes seasonal, it don't matter. We've got to include their income. If the mother who's staying there with them. You know, the wife's mother is living there with them. She getting SSI, Social Security, disability. She getting a pension from her dead husband. She getting a pension from whoever. Has to be included. It has to be included. I will put a link in the description also, not only for the rural housing maps, but I'll put in there for the income guidelines, because if you are over the income guideline, you cannot do a USDA loan. There are tests that we do to make sure that the people are actually eligible and can do a USDA loan. Okay. Again, wonderful loan, 100% low fees, much lower fees than the other programs, and it's very flexible, but we do have income limits. We have income limits. Also, on the rural loans, another thing you need to know is you cannot buy. Let me say this, on the VA, if you wanted to buy multifamily, you can. Whatever you want, there's really no discrimination on the property type on a VA loan. As far as single family, multifamily, because I've done loans for vets where they bought maybe a duplex and they lived in one side and rented out the other. And again, with the VA, you can own other property. With USDA, you cannot own any other property. Period. You cannot use a USDA loan to buy an investment property. Even if that investment property is in that rural area, you cannot, no, not on single family. We do single family here. You would have to do more on there's rural business. You might have to go over the rural business and the multifamily side, but you cannot buy remember the rural housing program is intended for people in rural areas to buy modest homes, and they are owner occupants. So even if let's say you own a piece of property, you inherited a piece of property, right? From somebody in Kansas left you a piece of property, and you trying to buy in South Carolina, whatever, in the rural area. No, you own that piece of property. It does not matter how that piece of property, that other property was acquired. Even if it was left to you, you own it. Can't do it. So just know those are the main drawbacks of a USDA loan. Okay. And another thing you may run into with a USDA loan is, in general, on the guaranteed side, USDA guaranteed loans, we won't do a whole lot of acreage. So if you're trying to buy like a mini farm or something like that, you're going to need to go to Farm Credit Services. You can't, it's not going to work with USDA. So let's just get that straight. But there are a lot of good parts, but just know the limitations when you're looking at doing a USDA loan. Okay, keeping it going. Number 3, I'm gonna go over FHA. FHA loans backed by the government. Normally it's a 96.5% loan. It's looking for you, the borrower, to bring 3.5% to the table to make it 100%. The good thing about FHA loans, you can get grants, whether it's from, as I mentioned earlier, like we have THDA here, you can get a grant to cover that 3.5%. And they got grants that are not only cover that 3.5%, it may give you a percentage or two towards your closing costs. Okay. But just know that your FHA is not going to be 100% loan. It's a 96.5. But you can have other organizations. You can get a gift. You can get, your family can gift you the money, whatever. The seller can pay up to 6% of your closing costs. So the FHA can be another loan that you can get into a house with minimal out of pocket. Okay. FHA has very competitive rates. They're normally a little bit better. FHA and VA rates are very similar, and your USDA too, because if the market, if you're looking at the market is saying like a conventional rate is like let's say a 7. Okay. Normally your FHAs will probably be like a 6.25. 6.5. It'll be a little bit better interest rate. Okay. There are no income restrictions. There are none. There are no income restrictions. What you need to remember is FHA has a front ratio and a back ratio. Your front ratio normally says that the house that you are buying, the property that you are buying, cannot exceed 29 to 30% of your gross monthly income. Okay? And then the back end ratio on an FHA says that that mortgage payment we just calculated at, let's say, the 29%, plus all your debts, can't be more than 41 to 42% of your total gross monthly income. Okay? So there's not an income limit like on USDA, but you've got to meet two different ratios. The front end is about the purchase, how much you're buying, and the back end ratio is your debt to income ratio with the mortgage and all your debts. Okay? FHA is not limited to certain areas. USDA is limited to the rural community. Okay? FHA, you can buy wherever you want to. There's, hey, in the city, out of the city, wherever you want to buy, you can do an FHA loan. There are no restrictions like that. Okay? One thing to remember about FHA loans have mortgage insurance premiums. There's an upfront MIP, mortgage insurance premiums, normally equal to 1.5% of your loan amount. I think it's higher than that now. I think it's like 2.25% or something like that. I digress, because it's 1.5%. I haven't done FHA loans in a while. Okay, but so you've got the upfront fee, and then you've got a monthly mortgage insurance premium. Okay. And the thing to remember is it used to be with FHA loans. Now, it's been years ago. Okay. Once you would pay down your loan amount to 80%, meaning you've paid down 20%, at 80%, you used to could ask that your mortgage insurance premiums be canceled. Okay. And what would happen is your mortgage company would send out an appraiser, and the appraiser would look at the value, would determine a value for your property. And if you had paid it down to 80% of that appraised value, then, and you've asked, then they could go ahead and drop your MIP, your PMI. It's same difference. And then it used to be, you could ask at 80%, but at 78%, they have to let it go. The lender has to drop the mortgage insurance premium every month, because you're no longer risky, because you're below 80% loan to value. Okay? That's how it used to be, but that's not the case anymore. Now, when you take out an FHA loan, you will have that mortgage insurance premium every month for the life of that loan. For the life of that loan. It doesn't matter if you pay that bad boy down to 50%, you are still going to have to pay that mortgage insurance premium every month. It never goes away. And just like I talked about in the with the USDA loan, first of all, the amount of the annual fee on a USDA loan is determined by Congress every year. Okay, so right now it's still 0.5%. It could be, I've underwritten USDA when it was higher, much higher. So it is adjusted to look at the pool of money that they have to do future loans. Okay, premium. Again, let me remind y'all, mortgage insurance premium is not for you. It's not for you. It is for the lender. You are paying an insurance policy against yourself every month on FHA. And it's just saying, okay, you have to pay in on this policy that the lender took out on you and your property. Okay. You're paying the premium, just like how you pay your car insurance. It's included, just like how you pay car insurance every month. You're going to pay MIP every month on an FHA loan. unless you're putting down 20% or more. Okay. So it just says that this policy, if for some reason you default, meaning you don't pay your mortgage, they got to foreclose on you, whatever, right? Okay. So when everything's said and done, when they get finished foreclosing on you, they done took you to court, they done all this stuff, right? They done hired lawyers, they done had to do a trash out, they done had to change the lock, put the house back on the market, sell it, all of that. So let's say the bank has spent $50,000 on you because you defaulted on that mortgage. Then they're going to go cash in that mortgage insurance, that policy that they've been having you pay every month, and say, hey, I had to pay out $50,000 because Rhonda didn't pay for this mortgage, and I had to foreclose. And here are all my expenses. And so I need my money back. And then even after that, once I sold the house because she had trashed the house wasn't worth, I lost another $50,000 on the sale of the house. Once I paid the realtors and I did this and I did that and all this and all that. And so now I'm $100,000 short. They're going to go cash in that mortgage insurance policy that you paid for. Don't get me wrong. I'm not saying one is better than the other. I just want y'all to understand the workings that go into each type of loan. So don't get in your mind. Listen, don't get fixated on you're getting a certain type of loan. Because if you get with a competent loan officer, they should be able to tell you, okay, yeah, let's say you're looking in a rural area. Okay, I'm gonna take my veterans out for a minute, just everybody else. You're looking to buy a property in a rural area, and you're thinking, oh yeah, I'm going USDA. I'm giving me 100% loan. The MIP is, there's no MIP. It's the annual fee, and this much less, and I'm gonna do this. But you make too much money. Do you see what I mean? You can't get a USDA loan. You make too much money. So because your household, you exceeded the household income limit. So you may need to flip to FHA. Okay. So that's why I'm saying, don't get caught up on a certain type of loan thinking that's the best loan for you, because you don't know until you look at everything. And again, you need to get with a competent loan person who can tell you which avenue you need to take. Okay, and finally, we're going to talk about a conventional loan. Conventional loans, you can get them in any bank. Any bank. Anybody can do a conventional loan, especially if you're A paper. A paper means you got at least 20% to put down. You got a strong credit score. You cool. You top of the line borrower. There are some, most of the time your conventional loans will require at least 5% down. At least 5% down. Now, there are some conventional, like a community mortgage. Freddie Mac had one. I know Fannie Mae has one where they may go to like a 97% loan. Right? So you only have to put 3% down. And a lot of your conventional loans, depending on the lender. Listen, conventional loans are not backed by the government. All three loans I just talked about, veterans, the VA loan, USDA, FHA, those are all backed by the government. It's a set of rules for each one. When you're looking at a conventional mortgage, that is determined by the individual lender who's going to lend you that money. So each one may have different rules. You see what I'm saying? Or different criteria, like the trade lines and everything that I've been talking about in these videos the last few weeks. So just know that conventional, each one can be very different because it depends on who the end lender is. And each lender may have different criteria. Some lenders may only require 620. Other lenders may require a 680. It just all depends. You know what I'm saying? So different lenders have different criteria. But normally they want you to put down at least 5%. There are some 97% conventional loan programs. They call it like a community mortgage, community something, right? But just know your mortgage insurance premiums are going to be double when you're doing a 97% conventional loan. Okay, so like if your mortgage insurance premium monthly was going to run you $150, you easily looking at $300 when you're doing a 97% conventional loan because you're riskier. You've only got 3% in the game. Okay. So they're going to charge you a higher mortgage insurance premium every month because you put less money down. That's just all it is to it. Okay. There are no income limits. Now, let me preface with saying, if you do a 97%, one of those community-backed mortgages that's, on the conventional side, sometimes they do have income limits because it depends on where you're buying. Sometimes you can only find those community-based conventional mortgages like in the inner city, the places they're trying to revitalize. Let's say, North Tampa, I'm just throwing a place out, okay, is a place that they want to encourage people to buy in. They're trying to build that community back up. It's the same thing they did here with North Nashville, okay? So then you may see community-based mortgages, like from, I'm here in Nashville, from your SunTrust, from your US Bank, from your Bank of Americas, from Regions Bank, okay, where they're trying to encourage people to move back into the inner city or different neighborhoods, right? And so they may have those community-based mortgages specifically for those neighborhoods, but at the same time, it's going to have a higher mortgage insurance premium on it. And sometimes those loans will have an income limit on it, right? Because what they're wanting people who serve that market. Let's say you're a firefighter, you're a teacher, you're something. They want the people who serve the people in that community to live in that community. That keeps the community strong. That builds up the community. So just double check. If you're looking at one of these community-based mortgages, look and see, ask your loan officer, are there income limits to that program? Now, like I said, on the, you will have an upfront mortgage insurance premium that will be collected. You will have monthly mortgage insurance premiums. Okay. The difference on a conventional and a FHA on that mortgage insurance. Remember when I just said you used to could ask when it gets down to 80% for it to be reduced, and then they have to, at 80% for your mortgage insurance premium to be canceled, but they have to take it down at 78. That's still the same on conventional. It's just FHA made it where you cannot get rid of that MIP. You cannot get rid of that mortgage insurance premium anymore, but you can still do that on conventional. Okay. Normally your conventional mortgages, you need a stronger credit score. Like with the VA, USDA, FHA, yes, in theory, on paper, they will go down to a 580. You're going to be hard pressed to find a lender who will do it, but it will go down to a 580. And when you have the lower credit scores, remember, you're going to get a hit. Don't you dare think if the going rate on a government-backed loan, like a USDA, VA, whatever, is today, let's just say today, is 5.5, but you trying to do 100% with a 580 credit score because you haven't done your homework. I'm not going to get into that. Because you ain't done your homework, then don't think you're going to get that 5.5, because there's going to be a bump on the rate, at least one bump on the rate. It's liable to be 2 bumps on the rate because you're down to a 580. In my opinion, don't go nowhere. Don't go where no loan officer, no nothing, until you at least at a 620, really a 640, 660. But I'm going to say 620 minimum, because at least if you got a 620, and then you go meet with a competent loan officer, they can, show you what you need to do to get your score up. Okay. But just know, you trying to do the bare minimum and get in here, you're not going to get the same interest rate. And then when your interest rate is higher, your DTI has to come down. Your debt to income limit has to come down because the interest rate is higher. It's an ever revolving circle here. You know what I'm saying? So just know that you may not be able to qualify for the house that you want when you have a 580 credit score, because there's going to be a bump on the rate. But I digress. Okay. Let me swim back around to my conventionals. Some loan programs limit you limit how much the seller can pay. Some of them, they will only let the seller pay 3%. Some let the seller pay 6% of your closing costs. Because remember, like I just said, it's an individual. Conventional loans are much more individualized according to the lender, according to the financial institution who's giving out that money. So they can have their own set of rules. Otherwise, on your conventional, you do not have a front end ratio like you do on FHA, saying you can only buy a certain amount of house. There's only one ratio, that's the back end ratio. But normally your back end ratio on a conventional is short, what I consider short. It may only be 36%, whereas FHA was 41. I've seen USDAs and VAs up to 50. Normally, you're going to be hard pressed to get more than 36 to 38% on a conventional loan. That's just how it is. Okay. So just know you got to have less debt because you have a shorter back end ratio on a conventional loan. Now, some of the positive of conventional loans, normally you can close them quick. It's not going to be a problem. It's so, they're run through Fannie Mae and Freddie Mac too. And so a lot of times, in my experience, once you meet the basic criteria, it's quick. You can get that bad boy done. They don't trip on appraisals. Normally, conventional don't trip on appraisals that much. Okay? So if there's a freaky, weird little house you want, or like, I don't know who's lending on a tiny house other than a tiny house builder. But anyway, if there's a freaky little house that you want a yurt, you want a barn dominium, you need to go conventional, because conventional loans don't trip on the property as much as a government-backed loan. Because remember, if it's government-backed, the government has to is going to be the person to have to deal with that house if you get foreclosed on. Okay, so you have shrunk that pool of potential buyers when you get these freaky, weird little properties. Okay. So the government don't want, we ain't finna deal with that. We ain't finna deal with that, because they're not in the property management business. They just want money. Okay. They want money. So you won't find your government-backed loans doing freaky, weird properties as much, if hardly, because they don't want to deal with that. But if there's a weird property or something special about this bad boy, you're gonna need to do conventional. If you have concerns about the location, let's say you can do a conventional loan out in rural country if you want to. You know, some people, if we used to do this fast and, goodness gracious, what was it? Fast and Easy. It was called Fast and Easy. It's conventional loan. This was before the crash. We used to do so many of them, baby. If you was strong, credit strong, you had your down payment, everything, baby, I could run you through there, get you done. I could have an approval today. If I had all your documents, I could get an approval. I could get you ready. You could close in 2 days from today. That's how good conventional used to be. Okay. But again, like I said, if you're doing a freaky, weird property, you want to do conventional. If you got the strong credit and the money put down and you want something quick and you want it done and you want the best rates, that's what you're going to do. Conventional will have some very good rates. But again, remember, you will have mortgage insurance if you're not putting 20% or more down. Now, the one thing I will say about conventional, the more money you put down, it changes your mortgage insurance premium. The factor rate comes down the more money you put up. So they all have their there's a use for every one of them. Let me say this. Just like I just said, if you looking in rural country and you exceed the income limits, you can do FHA. But let's say for some strange reason on that FHA, the front ratio is messing you up. then you may want to flip to a conventional. As long as you got that shorter back end ratio, that may work for you. So just don't get in your mind that there's going to be a particular type of loan that you absolutely know you're going to do until you talk to a good loan originator. Again, my name is Rhonda Burgess, and I've got some freebies for you all on my website. I'll put the link here on the screen. I'll put the link in the description. You want to support your girl, pick up some credit worthy merch. The links are down below the video. Thank you, and as always, have a blessed day.